The year 2022 began on the wrong foot, with the crisis in Ukraine, Russian sanctions, China's zero-COVID policies, soaring inflation, and interest rate hikes by the US Federal Reserve. These events were expected to have a stifling effect on the economic growth, raising concerns about a potential global economic slump. But amidst these worsening circumstances and ill-advised policy decisions, one of Biden's favorite economists, Mark Zandi, stated that the odds of a recession are 35%. When a recession hits, it is crucial to maintain a long-term perspective and manage exposures by reducing risk and setting aside funds to invest when the economy recovers. So today, I'll take you to what's a recession and how do you survive it. If you're new to the channel, hit the subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. While it is impossible to predict exactly when a recession will begin or whether one should altogether avoid risky assets, implementing good diversification ahead of time can help protect wealth and position oneself to profit from a rebound. To understand the potential impacts of a recession, it is important to look at the factors that have caused recessions in the past and examine what previous recessions look like. Over the years, the United States has experienced a number of recessions, some of which were more catastrophic than others. In 2020, the COVID-19 epidemic triggered a short-lived recession, marking the end of the longest stretch of economic prosperity in American history. The economic downturn, characterized by rising unemployment, business closures, plummeting retail sales, and sinking stock market, was considered the worst in modern US history. Similarly, the Great Recession of 2007 to 2009 was the most severe economic slump since the Great Depression. It was caused by the bursting of the housing bubble, resulting in widespread loan defaults and nationwide financial crisis. The economy shrank by 4.3% and unemployment reached 10%. While in 2001, the new century brought uncertainty, exacerbated by the dot-com crash and the aftermath of the September 11 terrorist attacks. While the 2001 recession was moderate compared to the ones in 2020 and 2007 to 2009, it still had significant impacts on the economy, with unemployment peaking at 6.3% and a slight decrease in GDP. With this historical context in mind, let's explore the causes of recessions and the signs to look out for. A reduction in GDP growth is often cited as an indication of a recession. Although it is more of a lagging indicator, economic statistics are reported after a quarter has ended, by which time the recession may have already been ongoing for several months. High interest rates also play a significant role in reducing liquidity in the economy. The Federal Reserve has historically raised interest rates to combat inflation and safeguard the value of the dollar. Recent interest rate hikes by the Fed, driven by concerns about inflation, can impact borrowing costs, leading to reduced lending and spending. Another factor that can trigger a recession is a stock market crash. Investor confidence plays a crucial role in determining the performance of the stock market, and a significant drop in confidence can drain money from businesses and lead to substantial market declines. While it is impossible to predict precisely when a recession will occur, investors can employ strategies to manage risk and potentially benefit from a rebound. Diversification is a crucial approach as it helps spread investments across various asset classes and sectors, minimizing exposure to any single risk. By adopting a patient and disciplined approach, investors can navigate economic downturns more effectively. In the past, wage and price restrictions have been imposed in an attempt to curb inflation. However, these measures can have unintended consequences. One example is the wage and price freeze implemented by President Richard Nixon in 1971. While the intention was to prevent inflation, businesses were unable to lower wages, leading to layoffs and reduced demand. The inability to lower prices further exacerbated the situation, resulting in the 1973 recession. Fast forward to the present. Excessive inflation has become a genuine concern for the economy's recovery. Bank of America has issued a warning about the dangers posed by inflation, as evidenced by consumer prices rising by 8.5% in March, the highest rate since December 1981. Record price increases have been observed across various sectors, indicating the impact of inflation on everyday goods and services. Another factor to consider is the state of the housing market. Declining housing prices and sales can have a significant impact on the economy. The Great Recession of 2008 was triggered by homeowners losing equity and being unable to secure second mortgages, resulting in reduced spending. Complex financial deals based on declining property values caused substantial losses for banks. While the housing market has been booming recently, with home prices continuing to rise, some analysts predict that prices will soon level out. Rising mortgage rates and declining demand may contribute to the stabilization. Long-term interest rates have already increased, with the 10-year Treasury note approaching 3%. The Federal Reserve plans to reduce its portfolio of Treasury and mortgage-backed securities, further contribute to rising mortgage rates. This tightening monetary policy is expected to impact house sales, making homeownership unattainable for many Americans. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the Thrive Wise love so we can help more people thrive wisely. And going back, according to Moody's Analytics chief economist Mark Zandi, higher mortgage rates combined with soaring house prices will discourage existing homeowners from selling and deter potential buyers. The average monthly mortgage payment has already risen significantly, making affordability a challenge. Zandi predicts that the limited inventories and high inflation contributing to rapid price increases in the short term will eventually reverse as more buyers are priced out of the market and rising mortgage rates dampen price across half of 2022. As we continue to examine the potential factors leading to a recession, it becomes evident that various economic indicators and policy decisions can significantly impact the overall health of the economy, from GDP decline and high interest rates to stock market fluctuations and housing market trends. Understanding these factors allow investors and policymakers to make informed decisions to navigate potential economic downturns. By remaining vigilant, implementing risk management strategies, and maintaining a long-term perspective, individuals and businesses can mitigate the effects of a recession and position themselves to thrive when the economy eventually recovers. Another factor that can contribute to a recession is the interplay between demand and supply within the economy. In the early stages of a recession, companies may cancel growth plans that would have been financed through loans, resulting in a decrease in loan demand. The cautious approach by businesses, combined with layoffs, can lead to concerned consumers reducing their spending and increasing their savings. The decrease in both business investment and consumer spending further exacerbates the economic downturn. During a financial crisis, lenders may become more risk-averse, and they tend to pull back on lending, potentially causing a credit crunch. This puts the economy at risk, prompting central banks to intervene and address systemic dangers. In a recession, interest rates tend to decrease, even if there is no credit bottleneck, as the reduced loan demand coincides with an increase in available savings. And lastly, the impact of the pandemic cannot be overlooked. The world has experienced the far-reaching consequences of the COVID-19 pandemic since 2020. The measures taken to contain the virus, such as lockdowns and restrictions, resulted in one of the most severe recessions in history. Even when economies began to reopen, consumers remained hesitant to return to pre-pandemic levels of spending due to fears and uncertainties. The employment losses further dampened consumer confidence and willingness to spend, prolonging the recession. The COVID-19 pandemic, now in its fourth year, has had a tremendous impact on both US and global economies. In response to the crisis, the US government enacted various policies aimed at providing fiscal stimulus and relief to those affected by the pandemic. The Federal Reserve also implemented significant monetary stimulus measures to complement the fiscal initiatives. Collectively, the amount of funds utilized to address the impact of the pandemic, as reported by USA spending, totals to an astonishing $11 trillion. These extraordinary measures reflect the severity of the recession caused by the pandemic. The combination of supply disruptions, reduced consumer spending, and economic uncertainty resulted in a need for substantial government intervention to stabilize the economy and support affected individuals and businesses. Understanding the multifaceted factors that contribute to a recession is crucial for individuals, businesses, and policymakers alike. By recognizing the interplay between loan demand and supply, as well as the impact of external shocks like pandemics, appropriate measures can be taken to mitigate the effects and facilitate a stronger recovery. As we navigate through these challenging times, it is essential to remain vigilant, adapt to changing circumstances, and implement sound economic policies that prioritize stability and sustainable growth. By learning from previous recessions and leveraging the knowledge gained, we can better position ourselves to overcome future economic downturns and build a more resilient global economy. Well, that's basically what's a recession and how do you survive it. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.